Well, Canada's economy has been hit with a long list of shocks in the past year. There's those higher interest rates, but also floods, fires, and strikes. October was no different. The St. Lawrence Seaway strike weighed on the transportation sector. So looking through those events, how is Canada's economy really holding up? For perspective, let's bring in Derek Holt. He is Vice President and Head of Capital Markets Economics at Scotiabank. Derek, thanks so much for joining us this afternoon.
It's a pleasure, Jacqueline. Thank you.
So we got this latest read on the GDP data, flat growth in the month of October. There were some factors to consider here, though. So how are you viewing the health of Canada's economy right now?
It's not great in terms of growth, but it's resilient in terms of the level of activity, especially when we take into consideration the panoply of shocks that have been thrown at the Canadian economy above and beyond rate hikes. I mean, in the latest month numbers from Statistics Canada, they attributed some of the weakness to the fact that there was an auto assembly plant that was shut. There was also spillover effects from the UAW strike in the United States. We had the strike in the St. Lawrence Seaway that also disrupted a number of sectors, transportation, warehousing, on through the agricultural sectors. On top of that, we had some problems at some upgraders in the and so there were a lot of these other factors going on at the margin that I think we have to control for in order to assess what's really going on in the economy. And doing so, I think we still would have posted mild growth. And this has been the story for about 6 months, so straight through to about last spring, even April. Just a series of strikes. Seems like half the country was on strike and the other half of the country was suffering from wildfires this summer.
Yeah, no, it was a very active summer on both fronts. When you're thinking about then how the Bank of Canada might be viewing it, I mean, we've talked so much about how data dependent central banks have been this year. And when you have data that is a little blurry because of some of these shocks, how do you think they're looking at it?
I think Governor Macklem has recently been very clear on that. He has said basically he's fade the data. He's expecting a soft economy. There are some tougher times ahead into the first half of the year next year, and he's expecting that. And so that's sending a message to the markets that it would take a really, really nastier set of circumstances to cause alarm in his mind and governing councils. And so I think that's probably a prudent set of messages. It's basically signaling to the markets, listen, we're expecting softness. Don't expect us to cut if we see that softness being delivered, unless things really skid off the rails into the ditch.
You know, it's really interesting, too. We've also had this other complicating factor this year, and that has been this population growth, record population growth. The latest data from StatsCan was for the third quarter, showing the population grew by more than 400,000 people, a record. And in terms of the pace of that, the fastest pace since 1957. You've been looking at that through the lens of inflation, also through the perspective of what sort of government infrastructure would be needed in order to support the number of people coming into this country.
Yeah, I flat out think it's excessive. I mean, we're sending a message here where we'll have a 430,000 population increase in the single calendar quarter of the third quarter of this year, equivalent to a brand new city of London, Ontario, or a new city of Kitchener-Waterloo. Over a couple of quarters, it's a new city of Hamilton. It's excessive. And in relation to the inability of the country to absorb it in terms of the housing stock and in terms of its infrastructure, the strains upon our hospitals and school systems and social services across the whole panoply of government-provided services, and in terms of the impact upon the private sector. And the message they're getting is, well, hang in there, just wait, 5 to 10 years from now, we'll have housing for you. And that's just in the near term, that's instead going to light up inflationary pressures right off into the spring housing market with strong population growth, 430,000 jobs created this year so far, and ahead of the final numbers we'll get in the new year. The fact that the 5-year fixed mortgage rate is dropping, given by bond market developments, the fact that wages are accelerating at the margin, first-time home buyers are amassing bigger down payments. And so all of this combination is a really dangerous combination of factors going off into the spring housing market. I certainly wouldn't cut in that environment.
You know, it is interesting because the Deputy Governor of the Bank of Canada, Tony Gravel, was talking about immigration and how it has fueled spending. But it seemed like sort of downplaying the impact on spending in the country. You know, that when you arrive here and you need to buy all that new stuff in order to get settled. He did mention the pressure on housing, but didn't really go into details about whether he thought it was a big impact on the housing sector or on housing inflation, shelter inflation. Why do you think that might have been, that there wasn't more emphasis on that?
I read it a little bit differently. I think that was a big chunk of his speech, that he was signaling concern about the housing market imbalances. They emphasized rent inflation that's going on in the Canadian economy. He could have chosen a different approach, and yet he emphasized that in terms of the weight within the CPI basket for housing and housing-related consumption going forward. I think they're cognizant of the fact that they don't want to do what they did at the start of this past year, when they signaled a pause and we're absolutely sure that we're done just yet. And then we went into the regional banking crisis in the U.S. and saw bond markets rally, cut mortgage rates, and boom, the housing market went on fire for several months. And I think they're very reticent to do that. And I think it's a prudent path. I mean, if we give away rate cuts prematurely, we could light up the same imbalances, and that would stymie the prospects for further rate cuts later. And I'd rather a little bit of patience so that we get a bigger reward later on down the road.
I want to touch on one other thing, some research coming from the Bank of Canada recently on the mortgage renewals and the impact that would have on Canadians' incomes. And it seemed actually relatively small in terms of that impact on incomes when you're thinking about the renewals to come. So 4% of a person's income would be going, or additionally would be going towards paying more on their mortgages. And I was trying to, wrap my head around that. So if you're thinking, if you were buying a $1 million house, according to Rate Hub, you'd have to have an income of $220,000 or so. So 4% of that, you're looking at $9,000 more a year, or about $755 a month it would break down to. Does that math kind of make sense? I mean, when you're looking at how much mortgage rates have gone up over that time, I would have thought that it would be a bigger impact. More money would be needing to go toward paying for those higher rates.
Yeah, okay. So the issue here is the fallacy of composition, and in terms of how economists would look at it, that what matters to an individual who's going through this pressure doesn't necessarily aggregate up to a big macroeconomic shock. It definitely matters to the people who are pressured by it and worried about it. I get that. But 60% of Canadian households don't even have a mortgage. And so at the macro level, this is a contained shock, first by that observation. Secondly, I've described this as being kind of like an economic mirage. The further distance that you have from the problem, you look down across the desert and it looks like a terrible, shimmering, giant problem. But the closer you get to it, the more likely you are getting toward rate cuts. And so that's what the 5-year Canada bond yield has been signaling. It's down at about 3.25% right now, quite low compared to the sell-off that we had earlier this fall. And that's probably going to continue as we go off later in the year, next year, and on into 2025, when we start to get that peak wave of fixed rate mortgage resets coming along. And so the punchline is, by the time we get there, I think we'll arrive and we'll say, well, what was all the fuss about? Rates have come back down again. We've had all this income growth that's been massive. And I think the Bank of Canada is right to conclude in this punchline that allowing for some modest income growth, this only knocks about 0.25% per year off of incomes in terms of the increased mortgage payments each year from 2024 to 2027. And even that, I think, might be on the high side of the estimates.